Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing which usually signals something big or a major heads up, like when your friend says we need to talk and you instantly know something's up. This time it's Prairie Operating Co. and they are making moves in the stock market. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Prairie Operating Co. just made an agreement to sell up to $75 million in shares of their common stock. Think of it like they're opening up a lemonade stand, but instead of lemonade, they're selling pieces of their company. This isn't necessarily bad, but it's important to understand why. This share offering isn't happening out of thin air. Prairie Operating already has a plan on file with the SEC, like having all the permits in place before starting a big construction project. This plan or registration statement allows them to sell these shares, and it became effective earlier this year. It's like having a pre-approved blueprint ready to go. Here's how it will work. Prairie Operating can ask these managers, Citigroup, Global Markets, and Truist Securities to sell shares according to specific terms. This request is called a placement notice. Basically, Prairie Operating sets the stage and the managers try to sell the shares based on that setup. The managers aren't forced to accept the terms though. It's like having a real estate agent. You can set your asking price, but they might suggest something different. The managers will likely sell these shares through what's called an at-the-market offering. This means they'll sell directly on the NASDAQ capital market or to market makers. It is important to understand they also can use other methods if the company agrees. The company is not saying they will sell any shares though, it's more of a maybe. For their efforts, the managers will get a commission which can be up to 3% of the gross sales price of the shares. They'll also get reimbursed for some expenses. It's like tipping your waiter. They get a percentage of the bill for their service. Prairie Operating has plans for the money they might raise. They want to use it for general corporate purposes. This could involve developing their projects, paying off debt, or even buying other companies. If a specific shareholder of a preferred stock demands it, they also might use a portion of the money to buy back some of its preferred shares. It's important to know that this report isn't a sales pitch. It's not an offer to sell or a request to buy any shares. If you want real information, you should look at the filings with the SEC. It's merely a disclosure of an agreement they have made. There are some legal documents attached to this filing. This include the equity distribution agreement itself and a legal opinion about the shares being offered. And it's pretty standard stuff, but necessary to make sure everything is above board. And here comes the most important thing, risk factors, because everyone likes to sugarcoat things, and this part is where they legally need to spell out what can go wrong and how bad it can get. As always, Prairie Operating included a long list of risks. It's like the fine print when you sign up for something, but you really should pay attention here because it's all the factors that could cause the company's actual results to be different than what they are hoping for. One of the biggest risks is estimating how much oil, natural gas, and natural gas liquids they have. It's like guessing how many jelly beans are in a jar. You might be close, but you're probably not exact, and if you are very off, things can go badly. Cash flow is key. If they don't have enough money coming in to cover their expenses, they could be in trouble. Raising capital is very important for what they are doing. Prairie Operating has been busy acquiring other companies, and they list risk of not integrating them properly. Think of making a cake, but the ingredients don't mix well. The final product won't be as good. Changes in laws and regulations could also throw a wrench in their plans. You can never be too sure when it comes to legalities in politics. They also recognize the importance of key employees. If they can't keep or attract talented people, their operations could suffer. All in all, these warnings are boilerplate but required for every single company. Now, what do I think about this? Well, it's a mixed bag. On the one hand, raising $75 million could give them the resources to expand and pay down debts. However, selling shares also means diluting the value of existing shares, like slicing a pizza into more pieces. Everyone gets a smaller slice. The fact that debt is mentioned is never a good sign. The oil and gas industry is always risky, with volatile prices and regulatory uncertainties. Prairie Operating is dependent on factors outside of their control. Overall, Prairie Operating's future depends on executing their plans well and navigating a challenging environment. And is not a bad company, but their high risk, high reward strategy means as an investor, you might get lucky or lose it all. Alright, that's our breakdown of Prairie Operating's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.